Let us begin this module by discussing about interest rate. An interest rate is the rate at which interest is paid by borrowers, debtors for the use of money that they borrow from lenders, that is creditors. Specifically, the interest rate is a percentage of principal paid a certain number of times per period for all periods during the total term of the loan or credit. Interest rates are normally expressed as a percentage of the principal for a period of 1 year. Sometimes they are expressed for different periods such as a month or a day. Different interest rates exist parallel for the same or comparable time periods depending on the default probability of the borrower, the residual term, the payback currency and many more determinants of a loan or credit. For example, a company borrows capital from a bank to buy new assets for its business, and in return, the lender receives rights on the new assets as collateral and interest at a predetermined interest rate for deferring the use of funds and instead lending it to the borrower. Interest rate targets are a vital tool of monetary policy and are taken into account when dealing with variables like investment, inflation and unemployment. The central banks of countries generally tend to reduce interest rates when they wish to increase investment and consumption in the country's economy. However, a low interest rate as a macroeconomic policy can be risky and may lead to the creation of an economic bubble in which large amounts of investments are poured into the real estate market and stock market. In developed economies, interest rate adjustments are thus made to keep inflation within a target range for the health of economic activities or cap the interest rate concurrently with economic growth to safeguard economic momentum. After starting this module, you shall be able to know what is the objective of an interest rate policy, understand the linkage between economic growth and interest rates, understand the linkage between inflation and interest rates, evaluate the transmission mechanism, know about zero and negative interest rate policies. Let us understand the goals of interest rate policy. The goals of interest rate policy are to promote maximum employment, stable prices and moderate long-term interest rates. By implementing effective interest rate policy, the central bank can maintain stable prices, thereby supporting conditions for long-term economic growth and maximum employment. Now, we shall discuss the interest rates and economic growth. Interest rates have economic impact as both an indicator and influential element in the growth of the market. The interest rates on large purchase items such as homes, small business loans and automobiles can show if the economy is healthy or if it is slowing down and needs an influx of cash to get going again. Next is low interest rates. In a poor economy, banks and other financial institutions tend to lower interest rates on loans to entice businesses to apply for credit. This allows money to circulate through the economy and stimulate growth. The process creates a symbiotic cycle where businesses use the loan money to acquire new property and build new locations that filters down to consumers and private construction companies, who are then hired to build new business properties and operate the new locations. Consumers use the money received from working to purchase goods and services at other existing business. Next is high interest rates. Rising interest rates are a strong indicator of economic growth according to the US News website. As economic development increases, more businesses reach out to banks and other financial lenders for extension of capital. Banks see this as an opportunity to earn a profit and slowly begin increasing interest rates. This must be done carefully, as interest rates that are deemed too high may lead to inflation. This economic condition is caused by an increase in the price of goods along with a shortage in available capital. Next is consumer spending. Interest rates also affect consumer confidence in the economy, which directly affects consumer spending. When the economy is experiencing a downturn, consumer confidence may be low, causing people to save more and spend less. Low interest rates may entice consumers to spend more on large ticket items such as cars and houses, but only if the job market is secure. Consumers who are unsure if they can keep a position long term in a poor economy are less likely to take advantage of low interest rates. Next is the risk of deflation. Interest rates that dip too low can lead to an economic condition known as deflation. This is an increase in available capital along with decrease in the price of goods. While this sounds like a good thing on the surface, it's actually quite harmful for businesses who now have to sell a higher number of goods to turn the same amount of profit. This can lead to a shrinking economy where the value of goods and property, including homes and other real property, decreases across the board. Now we will understand the inflation and interest rates. Whenever you hear the latest inflation update on the news, chances are that interest rates are mentioned in the same breath. In the United States, interest rates are decided by the Federal Reserve. The Fed meets 8 times a year to set short-term interest rate targets. During these meetings, the CPI and PPIs are significant factors in the Fed's decision. Interest rates directly affect the credit market loans because higher interest rates make borrowing more costly. By changing interest rates, the Fed tries to achieve maximum employment, stable prices and a good level growth. As interest rates drop, consumer spending increases and this in turn stimulates economic growth. Contrary to popular belief, excessive economic growth can be in fact very detrimental. At one extreme, an economy that is growing too fast can experience hyperinflation, resulting in the problems we mentioned earlier. At the other extreme, an economy with no inflation has essentially stagnated. The right level of economic growth and thus inflation is somewhere in the middle. It's a Fed's job to maintain that delicate balance. A tightening or rate increase attempts to head off future inflation. An easing or rate decrease aims to spur on economic growth. Keep in mind that while inflation is a major issue, it is not the only factor informing the Fed's decision on interest rate. For example, the Fed might ease interest rates during a financial crisis to provide liquidity, flexibility to get out of investments to US financial markets, thus preventing a market meltdown. Next is effects of changes in interest rate policy. It is worth remembering that when the Bank of England is making an interest rate decision, there will be a lot of other events and policy decisions being made elsewhere in the economy. For example, changes in fiscal policy by the government or perhaps a change in world oil prices or the exchange rate. In macroeconomics, the ceteris paribus assumption, all other factors held equal, rarely applies. There are several ways in which changes in interest rates influence aggregate demand, output and prices. These are collectively known as the transmission mechanism of monetary policy. One of the channels that the central bank can use to influence aggregate demand and inflation is via the lending and borrowing rates charged in the financial market. When the bank's own base interest rate goes up, then commercial banks and building societies will typically increase how much they charge on loans and the interest that they offer on savings. This tends to discourage businesses from taking out loans to finance investment and encourages the consumers to save rather than spend, and so depresses aggregate demand. Conversely, when the base rate falls, banks cut the market rates offered on loans and savings, and the effect out to be a stimulus to demand and output. Next is transmission mechanism of monetary policy. The transmission mechanism shows how monetary policy changes result in the changes in overall growth of the economy. Due to the changes in interest rates, the level of spending, investments and exports rises. Due to this, the level of production, employment and consequently the level of income rise. Eventually, it leads to increment in the level of GDP and price level as the aggregate demand rises. It may take around 1 to 2 years to see the full effect of interest rate changes on the level of GDP and the price level. Now, limitations to the transmission mechanism. There are some limits to the effectiveness of transmission mechanism. Often, banks are quite reluctant to cut interest rates even when the central bank has curtailed the interest rates. Besides, the level of investment, production, employment and GDP does not rise that easily since the investors are quite skeptical of the economy's performance after the recessionary period. Moreover, it has been sometimes seen that along with the cut in interest rates, some other rates such as credit card rates tend to rise. Moving on to discuss the zero interest rate policy. The United States, Japan and several European Union member nations have turned to unconventional means to stimulate economic activity in the years following the Great Recession. Economists believe aggressive monetary policy is integral to the recovery process after a financial crisis. After 2 decades of slow growth, the Bank of Japan decided to employ a zero interest rate policy (ZIRP) to combat deflation and promote economic recovery. A similar policy has been implemented by the United States and United Kingdom. ZIRP is a method of stimulating growth while keeping interest rates close to zero. Under this policy, the governing central bank can no longer reduce interest rates, rendering conventional monetary policy ineffective. As a result, unconventional monetary policy such as quantitative easing is used to increase the monetary base. However, as seen in the Eurozone, overextending a zero interest rate policy can also result in negative interest rates. Thus, many economists have challenged the value of zero interest rate policies, pointing to liquidity traps amongst several other pitfalls. Now, we will discuss the negative interest rate policy. A negative interest rate policy (NIRP) is an unconventional monetary policy tool whereby nominal target interest rates are set with a negative value below the theoretical lower bound of 0%. During deflationary periods, people and businesses hoard money instead of spending and investing. The result is a collapse in aggregate demand which leads to pricing even further, a slowdown or halt in real production and output, and an increase in unemployment. A loose or expansionary monetary policy is usually employed to deal with such economic stagnation. However, if deflationary forces are strong enough, simply cutting the central bank's interest rate to zero may not be sufficient to stimulate borrowing and lending. A negative interest rate means the central bank and perhaps private banks will charge negative interest. Instead of receiving money on deposits, depositors must pay regularly to keep their money with the bank. This is intended to incentivize banks to lend money more freely and businesses and individuals to invest, lend and spend money rather than pay a fee to keep it safe. For examples, an example of a negative interest rate policy would be to set the key rate at negative 0.2% such that bank depositors have to pay 0.2% on their deposits instead of receiving any sort of positive interest. The Swiss government ran a de facto negative interest rate regime in the early 1970s to counter its currency appreciation due to investors fleeing inflation in other parts of the world. In 2009 and 2010, Sweden and in 2012, Denmark used negative interest rates to stem hot money flows into their economies. In 2014, the European Central Bank ECB instituted a negative interest rate that only applied to bank deposits intended to prevent the Eurozone from falling into a deflationary spiral. Theoretically, targeting interest rates below zero will reduce the cost to borrow for companies and households, driving demand for loans and incentivizing investment and consumer spending. Retail banks may choose to internalize the cost associated with negative interest rates by paying them, which will negatively impact profits rather than passing the cost to small depositors for fear that otherwise they will move their deposits into cash. Though fears that bank customers and banks would move all their money holdings into cash or M1 did not materialize. There is some evidence to suggest that negative interest rates in Europe cut down interbank loans. Let us now summarize what we have learned from this module. Interest rate policy is an important instrument of the monetary policy. The central bank can use this policy as a method of increasing or decreasing the money supply into the economy, which can affect the economy in many ways. A reduction in interest rates will spur the economic growth, but at the same time will increase the chances of high inflation into the economy due to the increased aggregate demand of goods and services. Conversely, a rise in interest rates will reduce the amount of money supply into the economy, which will help the central bank to reduce the rate of inflation by reducing the aggregate demand. But at the same time, a reduction in interest rates will engender the level of production, employment and income to decline. An appropriate interest rate policy is one which maintains a fine balance between the pace of economic growth and the rate of inflation.